If you're choosing a mortgage rate based on today's headlines, you're already doing it wrong. This week is the perfect example why. Because while some mortgage headlines are suddenly whispering about possible rate hikes, the real signal, the one that actually determines your mortgage cost, it's coming from Japan. And almost nobody is talking about it. I'm going to tell you exactly what to do with your mortgage right now and why I'm comfortable making that call. If you're buying a home soon, renewing a mortgage soon, or you're sitting in a mortgage wondering, did I choose the right rate? Is now a time for me to optimize my mortgage? This channel is for you. I'm not here to just read headlines and regurgitate some AI slop and then tell you when it comes time to decide what you should choose for your mortgage, well, it depends on you. It depends what you want. Mortgages should be managed by experts, not guessed at. And that's exactly what you're going to do here is get expert management decisions every single week. No more set it and forget it panic term selections that frankly cost you tens of thousands in extra interest and worse, extra years and years of payments on your mortgage. I will tell you every week what the movements in the market are actually saying. I'm going to separate the signal from all the noise so you can make money-saving decisions, not close your eyes and pray type decisions. Hey, I'm Greg Williamson. I've been in the mortgage business for over 3 decades. And a few years ago, I realized something. The mortgage industry has been commoditized, which means people are forced to treat a $500,000 debt with considerably less strategy, read no strategy, than if they were making a $500,000 investment. And that's insane. So this channel exists for one reason, to help you pay less interest over the life of your mortgage, not just get a good rate today. Now, let's talk about this week because it's confusing people. You might have heard headlines saying, markets are pricing possible rate hikes. The Bank of Canada might be done cutting. Fixed rates are drifting higher again. And if you're thinking, wait, I thought rates were supposed to be coming down, you're not wrong. But you're also not getting the full story. Here's the part almost no mortgage video out there is explaining. Japan matters today more to your mortgage than most Canadian data today. Why? For decades, Japan has been the cheapest source of money in the world. The cheap yen funded global bonds, stocks, and yes, mortgage markets. Investors would get cheap Japanese yen at 0% interest and invested in Canadian mortgages. But recently, Japan announced massive stimulus while also allowing rates to drift higher. This has caused some global crisis. It also sounds contradictory, and it is. What it actually means is this. Japan cannot truly tighten. Their ridiculous debt load makes that impossible. So what you're seeing right now is some short-term volatility, not long-term tightening. This matters for where rates are going, more than it matters about what the volatility today is saying. And short-term volatility is exactly what creates confusing mortgage headlines. This is the kind of stuff where people read headlines, and sadly other mortgage professionals do also. And without the proper zooming out, people panic, grab a 5-year fixed mortgage rate today, hurry up before they go up, breathe a sigh of relief when they lock in a fixed rate in the low to mid 4s, only to find out this volatility was a signal. And then lower variable rates meant coming down and fixing lower fixed rates later in the cycle. Now, let's deal with the scary part head on. You might hear, again, markets are pricing rate hikes in 2026 in Canada. That sounds dramatic, but here's the truth. Markets are not forecasting hikes. They are pricing in insurance. A 10 to 20% probability is not a plan. It's a hedge. Central banks are pausing. Markets get nervous. Probabilities scatter all over. Media wants to grab headlines. That happens every single cycle right before rates actually move lower. The Bank of Canada is in a big dilemma. They are stuck, and it's going to become even more uncomfortable for them through 2026. Economic growth in Canada is very soft under the surface. Household debt in Canada is massive. This matters. If the bank hikes into a slowing economy in the future, they risk blowing up the economy and households along with it. Housing is also very fragile right now. Trade risk with the U.S. is very real. And speaking of the U.S., Trump has been open about the next Fed chair will be his puppet and cut the Fed rates down by 1% or more in 2026. This matters. Sure, the markets will price a premium on fixed rates for the obvious meddling of the president and the Fed, but no matter what the direction is still down. Trump just announced a massive stimulus, the Warrior Check, $1,776 to 1.4 million service members. And he hinted at another massive stimulus package of $2,000 to every American making less than $100,000. The big beautiful bill, tax cuts, and on no tax on tips or overtime goes into effect in 2026. And in his most recent State of the Union address, he announced plans for even more tax cuts announced in Q1. Add to these things is the very real problem the U.S. Treasury is in. The interest on the U.S. debt in November was the largest expense, higher than Social Security and health for the first time ever. Interest costs on their debt is becoming a crisis. They cannot have high bond yields, and they will do something about it. So with all this money printing in the U.S. and easing of their monetary policy, how is it possible that the Bank of Canada will hike into that? Like, think about it. Never mind that historically Canada follows us with a 92% correlation to the Bank of Canada. Hiking rates into that environment would break things very fast. It just will not and cannot happen. So yes, in the short term, fixed rates can and will wobble and be choppy. And given that, yes, banks will also probably pad their margins. But structurally, this is not a tightening cycle. We know that because both Canada and the US have already started quantitative easing, which is a fancy term for they print the money and they buy their own bonds and treasury bills. And this is more money printing on top of all the other stuff I've already said. And yes, there is going to be more cuts to the Federal Reserve rate, which is going to get imported into Canada. One last thing to set this up for you. When is the last time the US and Canada printed money hard? Oh yeah, COVID. And what did we see? Drop rates, print the money, stimulus everywhere. Now, for a different reason, yes, but nonetheless, it's stimulus and rates plummeted. We are at the beginning of a similar cycle. Yes, this cycle will flip just like it did after COVID when the bill, rapidly increased inflation, comes due. But that is a topic for future videos when we start to see that cycle flipping. So here's my call, clearly and without any hedging. Variable rate mortgages with a professional management strategy make the most sense right now. If you want to talk with us about a mortgage management strategy looks like, then let's have a chat. You can find me in the links below in the description or by scheduling a call directly with me. Now, I said, variable right now is the call. Not because rates are perfect today, but because flexibility wins when the signal is noisy. And it is very noisy right now. We are in the very beginning of this next cycle. In fact, we know the government in the US just stopped 2.5 years of tightening in their market. They dropped $3 trillion off their balance sheet. They raised rates much higher than we did in Canada. Very strong tightening in the US, and they just announced the end of that on December 1st. And then on December 12th, they announced that they're going to start buying their own bonds back. That's quantitative easing. That is more liquidity. That is more money printing. Money printing drives rates down eventually. So the goal here is not guessing the bottom. The goal is positioning flexibility so that you can act when it does show up. Most mortgage borrowers lose money because they lock in too early. They panic at headlines that describe today and not where we're going, and they're wishy-washy on advising on the future or never revisit their mortgage again. Set the rate today, don't look at it again for 5 years. That's a lot of money that's just opportunity lost. And so they listen to their advisors who don't really advise them. The biggest savings don't come from the rate you choose today. It comes from what you do next. I often say to customers, this cheap rate you look at today could be very expensive tomorrow. Every week on this channel, I'm going to cut through the noise. I'm going to explain what actually matters. And I'm going to tell you what I would do where our mortgage is. No fence sitting, no wishy-washy advice, no financial babble. So next week, I'll break down the exact signals I'm watching that tells us when fixed rates are actually in place that we're ready to lock. If you want your mortgage managed, not guessed, subscribe on the link below. I'll see you there.